Fed day today, May 4th, and the market just launched today. I mean, let's all give it up to Jay Powell today. He did a great job taking down rate assumptions, leading to some forecasts of maybe some reduced interest rate increases or slower pace of increases. We'll let the macro guys kind of sort through all that. But the big news, obviously, today is just this launch in the markets higher. As you can see, the S&P was up nearly 3% today. And this was a move that we were looking for several days. We went on to Tasty Trade last week. You could look up the Victor Jones show. And we talked about the fact that we had max put positioning in the market. And so if we zoom out just a little bit here, what you'll see is that we were highlighting this 4,200 area as what we call the lower bound with major support at 4,050. And essentially the idea behind that is we had max put positions. What that basically meant is that dealers were likely full up on puts. Yes, there was a bunch of people who own puts, and that leads dealers to be short. But on our site, if you go to SpotGamma.com, we break down the fact that dealers are also likely long tail hedges. And what this does is it adds some positive vega to their portfolios so that if the VIX index or volatility really spikes, dealers have long put options that is paying off, right? If you think about dealers like any other hedge fund, you can't just be short puts into oblivion. You got to have some positive convexity in your portfolio. That is, if VIX spikes and suddenly we wake up and the market's down 7%, that you can actually make money and survive the next day. So that is the concept of lower bound. If you just also Google SpotGamma lower bound, you can see how we outlined all of this. Now, the velocity in today's move, obviously, is something else. If you see, we stopped right at this 4,300 level, and I wanted to flip over to our founder's note. And what we basically said in the founder's note here is that assuming that Powell didn't come out and say, look, I'm going to do 50 more raises in the next 5 months or something crazy like that, we were probably going to get a rally, right? If he stayed neutral or if he went slightly dovish, we were going to get a rally. And that's simply because, again, we had max puts. And so there was really nowhere else for vol to go except for shooting higher. Now, what caught us obviously a little bit by surprise is the velocity of the move. We highlighted 4,300 as major resistance. If we're being honest, we thought it would take maybe another session to get to this level, but the move was so very strong on just one day. I think Powell was just maybe slightly more dovish than what some were expecting. If you want to read this note, go to SpotGamma.com, hit subscribe now, you get a free 7-day trial. But we want to talk about a few other things. So what led to the velocity of this move? Well, the big thing is the selling in volatility. So at VIX Central, you can go here and you can look at the VIX term structure. So this shows basically the prices of VIX futures out in time. And what this is basically saying is, a few days ago, we had what's called backwardation. Backwardation occurs in fear, and what that backwardation occurs during fearful markets when people are scared. And what that is basically people are willing to pay up for short-term protection, and that raises the price of short-term protection, and you get backwardation. So essentially what this is saying is front month is more expensive than the back month. People are really willing to pay up for put protection here, and that is big fear. Now today, obviously, not only did you get a move back to contango, but the entire curve deflated, right? So this is sort of all the way out in time. People are saying, okay, let's take a break now. We're going to rest. So this is a major collapse of the volatility term structure. The VIX itself, if we check the VIX itself, I believe it closed down around 25 today. Yep, right at 25. So it was at 28 or 29. I mean, this is a big decline, right, in VIX, as you can see here. So the nice thing for markets from a volatility perspective is we had very, very expensive puts, and now you could say the puts are not quite as expensive. Obviously, the rally in the S&P and the decline in volatility opens up the ability for some people to hedge some downside risk if they want. I'm not certain. We'll have to read a little bit more of the macro pieces to see, okay, this is a structural turn in markets. But our view coming into today was, look, we're set up for a good short cover rally. We've gotten a very strong short cover rally. If the Fed is a little more dovish than anticipated, okay, this rally can maybe extend. But we want to remind everybody what happened around the last FOMC. And that was, look at this rally over the last FOMC, which coincided with the huge put expiration for markets. Now, the difference here, as we've also outlined for subscribers, is that, look, the FOMC is going to take vol down, but there's not a big put expiration. Put expirations exist farther out in time, around end of May and end of June. So the extra put expiration kicker that we got around this March expiration is not there this time. So we're not sold on the idea that we're going to get this huge extended rally like we did at the end of March. Clearly, there's a lot of velocity today. Maybe this has a little bit more legs to it, but we're still under the view that selling rips or looking for opportunities to buy cheaper put protection is arguably the right thing to do in this current market. And one last thing to talk about, if you look at our hero indicator, what the hero indicator does is it measures real-time options deltas traded. So every single options trade that took place today, we look at that trade in real time when we look at what the hedging impact is of that. Do dealers have to buy or sell deltas? So essentially, if people were buying calls today, we would see this orange line here. It's this one right here. We would see that orange line shoot higher. And if people were selling puts, we would see the put line, the blue line, also increased. Those would be positive delta trades. What we actually saw today was extremely neutral options trading out of the FOMC. That's a little bit odd. We would have expected to see the call line and or put line both go higher. So if we just net those out, which is what this purple figure is, if we just net those lines out, what you basically see is the fact that, look, the options market didn't really seem to participate with new flow, with additional flow. We think dealers did have to scramble to buy. It's a negative gamma environment, so as the market goes up, dealers got to buy, and as vol comes down, this is the Vanna trade, as vol comes down, dealers got to buy more futures. So that can help push, obviously, the market. But, we look at Apple here, again, very neutral deltas, not a big directional bias here. Amazon, we can already tell based on the fact that this little circle here is in the middle, very neutral day. Microsoft had a big positive day. Netflix, Tesla, good positive delta day today. Big, obviously, deltas being bought in Tesla. So there was some call buying in single stocks, but overall, a fairly tepid response. Now, that was only in the 2 hours, hour and a half after the FOMC event, so we'll see if there's any follow through here. But again, we're under the idea that this is largely a short cover rally, and the problem with short cover rallies is that there's not a lot of support underneath, right? If those rallies fail, you don't have a lot of buyers, right? So we're going to have to do a little bit more macro analysis just to see, hey, look, does this thing have did the Fed come off as extra bullish here, or extra dovish rather? But under what we've currently wrote, we were looking for this rally. We labeled it going in here. We're saying we're looking for this rally. It's going to be short covering, and therefore looking to tactically re-enter into puts is our default view. So we hope this was helpful. If you have any questions, please leave them in the comment section below or send us a message at info@spotgamma.com.